Stocks are moving toward their highest levels ever. But our next guests say a pullback could be near. Frank Fantozzi, CEO of Planned Financial Services, and Charlie Smith of Fort Pitt Capital join us now. Frank, you say the technicals show that the market is overbought for stocks. Make your case, sir.
Well, you had the big sell-off coming in November and December of last year based on the election and the anticipation of increased capital gains. So a lot of individuals, investors, were selling off their positions and then finding the right time in their mind to re-enter the market, which based on the technical data, shows that things are being overbought this January.
I see. And Charlie Smith, you also think that things aren't looking so great, but for different reason. Tell us that.
Well, fundamentally, we're worried that that house prices are going to sort of level off here. We think that the natural buyers for housing really aren't there. We don't have a move-up market. Most of the buying that's been done in the housing market this year is foreign money and institutional investing. So we're having a hard time figuring out where the momentum is going to come from in housing as one of our issues.
Right. Well, Frank Fantozzi, let me just suggest that both of you gentlemen are stealing defeat from the jaws of victory. How about a little bit of hope here, guys? I mean, we've been worried for 2 years about a European meltdown, about a China slowdown, and about a government in the U.S. breakdown. All three big boogeymen seem gone and no longer a problem holding stocks back. What do you say, Frank?
Well, I think the biggest positive looking in, going forward, and which I think is really sustaining the valuation in the marketplace, is actually company valuations. If you look at PE ratios, they're currently around 13, and they're under the historical average of 16. So that statement alone makes stocks attractive to buy from a value standpoint.
Well, there, you're kind of contradicting yourself. I like that. Let's hear you, Charlie. What do you say?
Well, if we can get CapEx going again, and there are some signs that it's happening, house prices do level off or continue to rise, and bank lending gets going again, I could become a little more bullish. But we got the durable goods numbers yesterday, and they showed that year over year, durable goods numbers are basically flat. So it's all about CapEx, bank lending, and we need to see house prices continue to rise for us to get a little more bullish.
But wait a minute, Charlie. I thought we're seeing really good housing numbers overall. And didn't durable goods come in yesterday with a good number? Didn't we have a nice jump fueled by defense spending?
Well, defense spending, we believe, was very much a budget flush at the end of the year. If you don't spend it, you lose it. So, those numbers tend to jump around a lot. We had a big fall off in corporate CapEx in the second half of last year. It's gotten a little better in the fourth quarter, but we're really not sure that corporate America's back investing again. If we see that'll make us more bullish.
Yeah. Hey, Frank, one problem with the financial advice business is you guys, Frank, never get in as much trouble when I miss out on upside as you get in when I ride the downside. Then I'm mad at you. And so your advice can be a little more timid. Now, Frank, when you say we're set for a sell-off, you're not telling me in my 401k that I ought to sell stocks, right? I ought to stay in the stock market for the long term. Is that right?
Yes, our approach has always been to be diversified and just to plan in your long-term planning that you could see a slight pullback. Normally in advising clients, we're looking at areas where we feel that will provide a little more upside and staying away from areas that we feel that will prevent some downside. When you look at, for example, defensive stocks, those type of areas we feel, and even in a modestly growing economy, will underperform.
Okay. And Charlie, one last thing. You say that the S&P 500 this year closes out around 1,500. It's at 1,505 right now. Sir, would you like to bet dinner the S&P closes higher than 1,505 by year end?
1,506, sure. That's certainly reasonable.
Okay. Well, thanks for that small dollop of hope. We appreciate you being here. Frank Fantozzi, Charlie Smith. Good day, sir.
Thank you, Dennis.
Well, some